Hey everyone, welcome to a brand new episode of In the Money with Amber Kanwar. This episode was really fun. We have Josh Brown, the CEO of Ritholtz Wealth, on the podcast. And I think we've probably broke the record for the number of F words. So just if you're listening around your kids, this is your PSA that you might want to earmuff it for this podcast. He is unfiltered. He's candid as ever. If you don't know him, you'll see him all the time on CNBC. He started blogging, before blogging was like really that cool, under the pseudonym The Reformed Broker. And now he's the CEO, as I said, of Ritholtz Wealth. And he's got a lot of no BS takes on the market. So let's get into it. The information provided in this podcast is for informational purposes only and does not constitute financial, investment, or professional advice. The views expressed by the host and the guests are their own and do not necessarily reflect the opinions of any organization or company. The host and guests may maintain positions in any securities discussed on the podcast. Always consult a qualified financial advisor or professional before making any investment decisions. For over 25 years, Raymond James has been helping Canadians achieve their financial goals. They are Canada's largest independent financial services firm with over 520 dedicated advisors, $88 billion in assets under management, and capital market services. With no proprietary product to push, their advisors are free to focus on the unique needs of their clients. Whether you're saving for your children's education, preparing for retirement, or safeguarding wealth for future generations, Raymond James is committed to guiding you every step of the way. Visit raymondjames.ca today to discover how you can live a life well planned. Josh Brown, aka Downtown Josh
Amber
Brown.
Kanwar, aka In the Money. What's up?
So nice to meet you. I feel like I know you because I've really followed everything you write and things that you say. People will recognize you, of course, from CNBC, and you're part of a group of people. I think people think about like Wall Street or Bay Street, like Excel spreadsheets and numbers and deeply analytical. But then there's a crowd of people that's actually kind of poetic about the markets and prolific about the markets and speak really eloquently about what's going on in the markets. And I put you in that category. And I'm just curious, we're obviously going to talk about the markets, but like what moves you to, you're obviously interested in the market, but what moves you to like communicate about the market? And is that like a part of a hobby and interest that you have? Are you a secret English major?
Yes, that's right. I am the Judy Blume of stocks. You nailed it. And I'm here to let all of your adolescent listeners know it's going to be okay. The changes will come and it'll be fine. I don't belong in this business. I'm a very right-brained, creative person. I'm doing this by accident. Basically, my parents got a divorce when I was in 12th grade, and it severely fucked me up. And I went away to college, very immature, a lot of drinking and partying and chasing girls. I didn't focus at all on like the academic opportunity. It's no one's fault but my own. And so as a result, I really didn't know what to do with myself in my 20s. And my dad played golf with somebody whose son was making $100,000 a month. So he's like, go work for this guy's kid. Go get a suit. I swear this is true. Go get a suit, and whatever that guy's kid is doing, you do it. So I meet the kid. He's like 23 years old. He literally is making six figures a month. I'm like, what was your job before this? He was a bouncer at like a nightclub. So this is late 90s, Midtown Manhattan. It turns out I'm working at a firm called Duke & Company, which is later to be revealed as one of the most notorious Stratton Oakmont-esque boiler rooms ever. But I don't know anything. I'm just there like cold calling people. And all I see is people with Porsches and limousines, and they're going to Costa Rica every weekend. So I just assume these are successful people. Anyway, I end up falling in love with the stock market is the point. And not from a mathematical perspective. I was never like a sell side analyst. I was never doing discounted cash flow analysis. I just loved the idea that you could learn the story of a company put money directly into it and then watch that story play out, sometimes win, sometimes lose. It's the only thing I've ever done since. So I spent the first half of my career as a retail stockbroker, telling stories, asking people to send me money. And we can get into the evolution of my career if you want, but like that's what I'm doing here. I probably should have been working at Pixar or something.
Josh, I love that. I'm a big proponent, investing changes lives, and you're proof of that. And part of, I was at BNN Bloomberg for a long time, and I felt like most of my job, obviously I have to understand the markets, was really about communicating the market, just like strip away the jargon, because at the end of the day, this is something that everybody should have access to, because to your point, I mean, it can change lives. And I feel like you experienced that when you started talking about it during the financial crisis. Like that's kind of how you went viral, right? When you started the Reformed Broker, I guess you didn't anticipate that it would take off and lead you on this path. Now you're the CEO of like more than $1 billion registered investment advisor.
So I started a blog out of frustration. I was basically at or near rock bottom in my life. Career, personal life was okay. So I had a wife, a baby, and we had another baby on the way, a mortgage, and the world was melting down. All my friends at Lehman Brothers, Bear Stearns, they all losing their jobs. All my friends are moving out of the city. We had to move out of the city to the suburbs. Could barely afford to live, basically. And my clients who were invested in like mutual funds and, ETFs and blue chip stocks, all their accounts were cut in half because that's just what the market did. And, I was a commission-based broker at that time. So if you don't do transactions, you can't get paid. Like I was not on a fee base as an advisor. I was a retail broker. So it's like you either sell people stocks and charge a commission or you starve. And I starved. Mm-hmm. So I spent a lot of months in that place. Like I'm not gonna tell people they should start doing stuff with their accounts just to generate commissions. So I explained to my wife, who does not know anything about the stock market. She's like, well, I don't understand. You go to work every day. I see you leave in the morning. I know what time you come home. How the hell did you make $1,000 last month? Like you work 50, 60 hours a week. I said, you don't understand. She goes, no, I understand. You don't understand. If you're in a situation where you have to do the wrong thing by your clients, i.e. trade their accounts into a crash, like if that's the only way you can make money, guess what? You're in the wrong business. It really, Amber, it took a revelation from somebody that knew nothing about the industry from the outside to just be like, the hell is wrong with you? Like that's how you make money. You have to convince people to trade, even if it's not advisable at that time to trade. So that's really the genesis of me starting the blog and starting to speak publicly. I had no idea like what it would turn into. I just tried to be myself.
I think a lot of people went through that experience, and it's a long time ago. For the kids listening, we've got a big youth demographic. They might not remember. They might only think stocks go up, right? And corrections last for like 4 minutes. But that was a really dark time, and it took definitely certain parts of the U.S. a long time to recover. And I feel like, Larry McDonald, we've had him on the show. Those kind of experiences can kind of make you not permanently negative, but permanently like glass kind of half empty, right? And I feel like
McDonald, is that a Larry? Yeah, Larry thinks it's always Lehman o'clock.
Like literally,
Larry's a friend of mine, but every time the market corrects 5%, it's the next Lehman. I totally get it. I'm very anchored also, not to the financial crisis, to something before that. I'm extremely anchored to the 1999 2000 .com bubble, and I see parallels to that everywhere, and I have to work so hard to talk myself out of them, and thank God I have. But like, I agree with your statement, like your formative experience as an investor, or this moment where you were right and everyone was wrong, which I think was the experience Larry had, like that, it's really hard to like break out of that paradigm or remind yourself that history doesn't actually perfectly repeat. It's just not everything is an analog to this unbelievable moment in time that you're anchored to mentally. So I try really hard to fight it also.
It doesn't necessarily serve a long-term investor, right? If you don't get 2008 right, it's totally fine because if you just held on, you would have done super well. But that brings us to the vibes right now, the zeitgeist right now. Everybody's talking about .com. Everyone's talking about these parallels, the trillions that are being spent on AI infrastructure. Today, we're filming on a Wednesday. Today is 6 months since the tariff low. Both Canadian US stocks are up 35%. On the TSX, there are only 12 stocks since then that are in the red. Like it's so easy to make money since that tariff low. And sometimes that makes people a little bit nervous. Talk to me about, are you nervous?
Yeah, but you're you're cherry picking a starting point.
Yeah,
so
totally.
here's the actual story of what happened this year. Stocks went down 20%. NVIDIA went down 35%. That's within this year to date, within the last 9 months and 1 week. That's literally a thing that happened. We saw the biggest stocks in America get absolutely smashed. And we saw outright crashes all over the market. Like that happened this year. So if we want to say like since the April low, yeah, it's a really impressive rally. But like, how many people put their first dollar in the stock market on April 7th? It's just not the lived experience. So you could look. This is one of the great rhetorical tricks of the market pundit, and believe me, I know. You can say anything with data, depending on when you want to set the starting point. So if I say over the last 5 years it's been a bull market, but in 2022, Meta and NVIDIA were down 70% from their highs. Amazon was cut in half. Microsoft was in a 30% drawdown. Apple too. That's a 20% bear market in 2022 and a 35% bear market for the NASDAQ. That's within the last 5 years. Then we had this tariff thing happen just a few months back. Like it's not like a primrose path. Like everyone's just like constantly making money. Now, it's been more good than bad. You're 100% right. But like the lived experience of the investor can't be boiled down to one particular date and starting point, because it's just not what we actually are living through.
You're right. And I feel like especially your point about like you can pick any data point to confirm your bias going in. And it's really more about who's in control of the market. Is it the bulls? Is it the bears? Is there widespread, optimism that things are going to go well, or is doubt starting to seep into the market? So with that in mind, like, how do you think about where the market goes from here? Because valuations do matter. Returns on the capital that is being spent does matter. I guess the question is, when does it matter?
I watched Jensen Huang on CNBC with Kramer, and then again with Squawk Box just this morning. And, the point was brought out, and I think it's a valid one. Anyone could look at a growth business where there's fungible spending, and they can conclude, well, you're spending this much here and you're only doing this much in revenue. Therefore, I have calculated from the outside looking in your return on investment as blank. It's just not how it really works when you're talking about these mega cap conglomerate tech giants. We don't really know the profitability of each individual activity. We can only, I think, look at like the whole picture. It's very unlikely that all of the CapEx spending that's powering this rally, when we look back, is going to prove to be wise. Of course it won't. There are misallocations of capital everywhere. We won't know the extent of it, and we won't know which investments were the great ones and the bad ones until we can see it in the rearview mirror. One thing I would say is, you either believe that this generation's executives are smarter than those executives from 25 years ago and that they've learned something from them, or you don't. So this is a really important point, actually. My entire career, I've been told that the stock market is overvalued relative to history. People look at cyclically adjusted PE ratio, and they say, well, it should be 10 at the bottom of the market, and it never bottoms at 20. The stock market never bottoms of course, the cyclically adjusted PE ratio has been in the 90, has been in the top 5% of valuation in forever. It's because companies are better at being companies now than they used to be. We're not going to mean revert to 1970s and 80s profit margins. Meta is never going to look like a coal mine. I don't know how much evidence do you need to understand that mean reversion that you're waiting for is not going to happen. I feel the same way about the executives at Oracle, at NVIDIA, at even the companies that were around back then that are involved in AI today, Cisco, Dell. These people know what happened in 1999. They're not stupid. They read textbooks about the dot-com overspending CapEx. Like, can we give people a little bit of credit that they're not operating in a vacuum and that corporations haven't gotten smarter and better over time? Why wouldn't they have? Do you want to see today's NBA players play the guys that were playing 25 years ago? You think that would be fair? Like, are we saying that companies don't get better over time and executives don't get smarter and aren't schooled on the history in their own industries? So I'm not telling you it's not bubble-ish. Just think this idea that we're going to have a NASDAQ crash 85% just so it could rhyme with 2000 is kind of childish when you think about it.
So if that's your view, how does one express that in the portfolio?
Stay invested, respect trend, understand whether or not you're participating as a trader or an investor, understand that they're not the same thing. Don't put all your eggs in one basket. Have aspects of your portfolio that act as a just-in-case mechanism, whether it's a tactic or a specific strategy or a mix of asset classes. And above all, this is the most important thing, shut the fuck up. The most important thing. If you are one of these people pounding the table that only you're right, everyone else is an idiot, that's going to come back to haunt you because it's going to alter your ability to be as flexible as you need to be. Everything I'm saying right now is my opinion. Let me finish this. Everything I'm saying right now is my opinion circa October 2025. I reserve the right to change my opinion in 20 days if I feel like it. All of the greatest investors have had that ability. Buffett, David Tepper, you look at Druckenmiller, you look at the guys that have put up the most impressive track records. They can change their mind on a dime. They don't owe anyone an explanation. And they say, well, that was then, and this is now, and this is what the data is telling me today, or my gut feelings, or whatever it is. Soros, Steve Cohen, all these guys, none of them go out publicly and pound their fist on the table and then stick to that call. Why would you? So the most important thing is just shut up. Don't go calling all your relatives and telling them buy this, buy that. Like, don't personally get yourself so involved with a position or a price target that you can't listen to anything that's contrary to that, because that's the kiss of death in the market.
It's funny because we hear people like Ray Dalio, for example, has just been on this drum beat, and when you listen to him, it scares the hell out of me.
I mean, he's not running the portfolio anymore at Bridgewater. So I have nothing but respect for Ray Dalio, but like, this is a billionaire. Does somebody earning $200,000 a year trying to pay down their student loan and make a mortgage payment have anything in common with a billionaire? Is that, let me get this straight. This person's worth $5 billion, therefore I should take their investment advice. Do you understand? You're not even in the same sport, let alone the same ballpark. Like, you're not even engaging in the same activity as that person is engaging in.
They're in a different They're in a different operating system, I feel like.
It's another planet. It's another planet. You're talking about aliens and Earthlings. Ray Dalio is an alien. He's one of a very small handful of people who have been able to make billions of dollars for others and for himself, literally forecasting the global macro economy. Do you have any idea how hard that is to do? None of that translates to what should your retirement portfolio look like. None of it. Ray knows that.
And one of the things you know about that retirement portfolio, you just said you want to stay invested. Where do you or how do you express the just in case part, the potential downside?
In a lot of ways. So the number one thing that I want you to understand is that we don't run a hedge fund or a mutual fund. We run separately managed accounts. So we have 4,000 client households, and all of them are different in different ways. Before we allocate a dollar of anyone's money, they go through this very extensive financial planning process, which enables us to figure out what they need, what they want, what are some of the options or turning points where we might make a shift. What are some of the things that are specific to their own lives that might impact liquidity or timing, sequence risk, et cetera? I mean, that's multiple calls and meetings before we've been paid a cent and before we've recommended even a money market fund. The reason that's so important to our process is we're going to take that information and come up with the appropriate portfolio recommendation. And oftentimes, that appropriate portfolio recommendation is going to be a mix of not only asset classes, but strategies. And so the answer to your question, like how do you express that stay invested, but just in case, is different on a case-by-case basis. If I've got a couple who neither of them are working and they're funding children and grandchildren's lives, and that's what they want to do with their money, and they're in the state of California, it's probably going to be a very heavy municipal bond allocation, tax-free bond allocation. If I've got people in their 30s and they're both engineers, one works at Uber, the other works at Amazon, that's going to be a very different answer too, because ostensibly so much of their compensation is coming from technology company stock. That's a totally different allocation and answer. So it is a mix of asset classes. It'll be unique to each situation. It's also a mix of strategies. We have an in-house tactical asset allocation model that will move based on technicals. Doesn't make sense for every client. It's not in every client's account. We try to run that in tax-free IRAs because there is enough movement that we don't want that to become a tax liability, taking a huge profit in the triple Qs, for example, in order to get tactical in a bear market. So there are a lot of things that we're doing, from 130/30 funds to traditional asset allocation between stocks and bonds to tactical asset allocation, options overlay. But the answer is always going to be a function of who is the person and what's the right mix of strategies and assets for that person.
I get that it's, obviously the individual dictates, how they're going to protect that downside. Let me put it to you another way.
We dictate based on the individual's own unique risk tolerance and goals.
Let me put it to you a different way. Right now, you've got tech, the market rallying alongside gold, which is traditionally thought of that downside protection. What do you think the signal is what do you think gold is telling you? That it makes record after record at the same time that you've also got kind of a risk on trade?
I think there are two buyers of gold. The first are central banks. They are, I think, ever since the Russian invasion of Ukraine and the United States and Europe freezing Russian assets, not just government assets and bank accounts, but people's personal bank accounts, the oligarchs and the Putin friends and family club. I think that was a wake-up call that in the international banking system and in the U.S. dollar, there wasn't this ability to just do whatever you want. And I think foreign central banks, either of their own volition or because someone involved in the political leadership of these countries basically gave the order, hey, we might want to go easy on the dollars and go a little bit more heavily into things that the dollar can't really affect. And of course, like top of the list is gold. Everyone understands this. So I think that's a very obvious bull market in central bank accumulation of gold. Simultaneously, Trump comes back into office and starts announcing trade policies on Twitter at 4:00 in the morning. Just makes up numbers, sits in the Rose Garden, puts up a styrofoam or whatever it is, poster board, 150% tariffs on this country and that country. Now, of course, none of that actually ended up happening. The tariffs are much more like normal relative to history than what we originally thought. But again, that's another wake-up call. It's like, look, the world relies on the reserve currency status of the dollar. But I think a lot of people are just like, all right, this is a little bit more volatile than we've ever seen U.S. trade policy be and a president ever act. And they see that, Scott Bessent is in the mix. And it's not a lack of confidence in the dollar. It's an enthusiasm to have the dollar plus other things just in case. So that's the first bull market. The second is the momentum created by that attracts the retail and the institutional crowd. So you've got like people now automatically allocating to gold ETFs, which I'm one of them. And then you've got the momentum trading crowd that's involved in the miners, and it sort of feeds on itself until it stops. It will stop. But that's why gold is rallying, and it makes perfect sense when you understand the drivers behind it.
Let's go to our friend, back to our friend Larry, who makes the point that it's something more. It's always something more, but that it is a shift in where the source of outperformance is going to come from to hard assets and away from intellectual property. Gold stocks are outperforming the Mag 7 over the last year. And
how about over the last 10 years?
Yeah. I said the last year. I picked my time frame.
Great job.
But that it's a signal. I'll do 10 years. 10 years, the Mag 7's up 2,000% and gold stocks are up 500%. That it's a signal that, yes, the last 10 years plus were about intellectual property overcoming hard assets. And it's not just him talking. He was our recent episode, but we've had actually a lot of people, and it makes sense. We're in Canada, so we're like raw gold stocks. It's a big part of our index. But also, is it a shift, or are you just saying, no, it's just a mean reversion? They're just catching up.
I don't know. I'll tell you 3 years from now. I'm telling you why people are buying gold.
Yeah.
Central banks are buying it because of their lack of confidence in consistency in the U.S. government and political situation right now. And momentum buyers in both institutional and retail accounts are following that uptrend and reinforcing it. That's what's happening. I don't know that that's necessarily a signal, but maybe it is. Larry might know more than I do about that. I would just point out there's nothing wrong with owning gold. But like convincing yourself that there's like some cataclysmic shift taking place that you absolutely must adhere to, like that's the kind of thing I can't afford to do personally or with my clients, because if you get that wrong, it's hugely problematic. In 2011, I was in a different part of Canada than you are. I went to Vancouver. I gave a speech at a gold conference and they booed me. This is a true story. You can look this up. This is July, maybe, I want to say. When would they invite people to Vancouver? Probably June or July.
I mean, anytime. Yeah, anytime's a nice time to be in Vancouver.
No,
yeah,
for
that's
like a big international conference.
Like a mining conference?
Yeah.
Okay, all right. So you're July 2011. Let's hear it.
June.
What do you say?
Whatever. Gold topped. Gold had actually, earlier in 2011, GLD had a higher market cap than SPY. Think about that for a second. More AUM than SPY. That was an obvious top for gold. I didn't see it at the time. I'm just pointing to it 13 years later. But gold fever had broken by the time I get to this Vancouver gold miner convention or conference or whatever it was. The reason why I got booed is because I just went on stage and showed people the technicals. Like, here's an 8-year uptrend for gold on a monthly closing basis that just came to an end 2 months ago. Like, I have no idea how many cubic ounces of gold are going to be mined, or the demand from India during Diwali season. I don't know any of that shit. I'm just telling you, the buyers allowed gold to break below this very obvious trend line that had been in place for almost a decade. So you could ignore it, and maybe it's a head fake, or you could wake up to the fact that gold is a commodity. It's not different from oil. It's not different from any other commodity. It's got boom cycles. It's got busts. It's just part of the deal. And it might not continue on this bull market any longer. It might be time to lighten up or do something different. And people in that audience were absolutely furious. And, they had Doug Casey and they had like all the gold guys. And I listened to some of them, and I don't think I'm smarter than them. They were very pessimistic and bearish. They were pitching people, you should buy farmland. Within 3 years, this continent is going to be unrecognizable. You're going to have to live up in the mountains because California and Florida will be underwater. And it was like this whole shtick. And that's what all these people were fueled up on. And then on the last day of the event, they put me on stage, and I'm like, gold is in a tactical breakdown. And people are like, what do you want us to die? I'm like, no, I'm not trying to be a dick about it. I'm just telling you, this has been an amazing rally for gold, and it might be over. Now, I was right.
It was over.
Now, I wouldn't have predicted like it's going to be over for 10 years, but gold literally was in a 10-year secular bust or bear market. Go look at a chart. It did not regain the 2011 highs until 2021. Not coincidentally, when the money supply exploded again in response to COVID, all of a sudden gold got back to its old high, and it's been rallying ever since, and it looks amazing right now. And I actually think it goes higher from here. But like, just trying to be reasonable, just be like, look, this has been an amazing rally. You think this goes on every month forever for the rest of your life? That's your honest opinion? Can't listen to anything that someone else has to say? So Larry could be right. I don't know. It's not my area. I'm not a macroeconomic forecaster. My track record would be terrible if I was. I don't. Well, and you can get macro under the assumption that I'm going to outguess the world.
You can get macro right and the market wrong all the time.
Sure, of course. So people do. It's okay. We're all human. This idea that someone like has the pulse of the entire globe. Come on, what are we talking about? Think about how insane that prospect is. So that's not my thing. I don't do it. We build durable portfolios that will enable our clients to retire no matter what happens.
Okay, we're going to take a quick break here. If you have plans to go to the US, this is our second part of our mini-series about cross-border investing. Remember, I spoke with Darren Coleman of Portage Wealth, which is part of Raymond James, one of our sponsors, about what Canadians should do with their registered accounts if they're planning to move across the border. Let's talk about a situation where you're from Canada and you're going to the US, but you probably have a bunch of investment products, whether they're an RRSP, an RESP. They don't have those in the US. What do you do?
Well, getting an audit, if you will, or an inventory of what exactly the accounts you have are and which ones can you keep while you're in the United States. Some of them are fine. They're covered under the US tax treaty, like an RSP, for example. Those are fine to leave them, unless you go to certain states, because not all states follow the Canada tax treaty with respect to state tax. So the most popular example of that would be California. So if you're moving to California, California does not recognize the tax deferral of an RSP. There's a few steps you want to take before you go. Other states, not really an issue. So knowing where you're going and getting some good advice before you leave is really important. Other account types aren't recognized at all, or the tax treaty is completely silent. So, for example, the newest one, the first home savings account, is not recognized at all by the IRS. So if you've already set one of those things up, you may not want to have it when you go to the US. So having a good conversation with an advisor that knows about these things is really important before you go.
What about a TFSA?
That's a tricky one. So some tax advisors take the perspective that they believe it should have the same tax deferral as a Roth IRA, which is what the similar equivalent would be in the United States. Others say don't have one at all. So getting the right advice is important because now I think people are interpreting what they think the right answer should be.
All right. Well, for more on what those complexities are and how to navigate them, you can go to portagewealth.com. I'm going to ask you such a Canadian question. We always ask Americans, what do you think about us? What do you think about us over here? So we got a lot
I love Canada, so.
We got a lot of questions, actually. If you're coming here, are you going to set up shop here? Have you thought about that?
We think about it all the time, but you can't do it. The regulators do not want American RIAs to just come in and start steamrolling local firms, even if they could. And I don't think they could. I'm friendly with the guys at Q Wealth.
Mm-hmm.
I happen to think Jared is one of the most exceptional entrepreneurs I've ever seen in the financial advisory business, U.S. or Canada. I've spent a lot of time with Canadian advisors at Future Proof over the last 4 years. Canadian advisors are coming by the hundreds at this point to Huntington Beach, California, to Miami, everywhere we throw our events, and they are super sharp. They understand that their market is 10 years behind ours in the wealth management business, but they are killing themselves to catch up. And we share a lot of overlapping beliefs about the right way to treat clients, the need for a fiduciary standard, the strength of connecting people's real lives to the portfolios we're recommending, the power of fintech. So I'm a huge fan of the Canadian wealth management industry and the financial advisors that I've met, and I know hundreds by now. I think at least 100. I would say. Why aren't we there? The regulators are not interested in seeing like the U.S. like creative planning come in and open 500 offices across Canada. Like that is not what's going to happen. So we're cool though. There's plenty of opportunity.
Well, it's going the other way. Like a lot of Canadian companies, as you know, they're expanding gangbusters, in the RIA channels in the U.S.
I know, CI.
Yeah.
So now that's Corient. I don't know. I talk to the advisors that work at that firm. Half of them are like, I run my own firm. I just use them for back office. Yeah. I think that's more like a platform. Than it is. But so that's one example of a gigantic Canadian company making a really big splash here in the U.S. wealth market.
Do you ever spend time thinking about the Canadian economy, Canadian stocks? We like to champion our low valuations, our higher dividend yield, our strong banking sector. To be honest, like tech is just not, if it's just not a sector that we do particularly well. Nortel, BlackBerry, we do have Shopify, which is volatile. And I feel like it's basically an American-owned company if you look at the shareholder base, because again, we just like don't have that kind of risk tolerance for money-losing growth companies.
I'll actually take it a step further. The most dangerous place to be in this world is a shareholder in the largest company in Canada.
If it's not a bank. If it's not a bank.
No, even if it is a bank.
Why?
I think it was RBC during the financial crisis for a minute, and then that wasn't fun. Valiant, Nortel, Research in Motion / BlackBerry. Like once you become the largest company in Canada, bad things start to happen. So it's funny, but it's also true. This is my entire career. I've watched this. Nortel went bankrupt. BlackBerry virtually disappeared, absolutely crashed, is not even in the phone business anymore. Valiant was revealed as a massive fraud. It's like not great to be the largest market cap company in Canada. I think the world of Shopify, I think building basically the Amazon for the small business that's trying to compete with Amazon is a brilliant idea, and they've executed. I don't really have an opinion on Shopify stock. It's a huge winner. Nobody needs me to endorse it. It's done really, really well. But But yeah, I mean, I guess I've owned Canadian stocks. I've owned Canadian gold mining stocks. I care more about, is this thing going to go up?
Yeah.
I guess I would say more than
Don't we all?
more than anything else.
You mentioned tariffs. Is that still a factor? We pass it. Like, do you think tariffs have the ability to shock the market again?
I don't think the market will be shocked, but I think individual companies and sectors will continue to be shocked. But then I think like the risk is to the upside. So we just saw an example of that with Pfizer.
Yeah.
Like the White House, like, says whatever they're going to say, like, oh, we're going to do 100% tariffs. And then like a CEO calls Trump and is like, dude, what are you doing? Like, I'm going to have to lay off 50,000 people. He's like, oh, all right. Will you build a plant in the United States? Like, will you build a manufacturing facility? He's like, yeah, but like it takes 10 years to build these things. You understand that, right? I'm building commercial scale laboratory. All right, I'll tell you what. Just break ground. Put the shovel in the dirt. I'll send Lutnick over. We'll do a photo shoot, and then you're good. And then people look at the sector and they're like, wait, that's it? That's all you have to do? So it's like, I think the shocks are more likely to come to the upside from because everyone immediately assumed worst case scenarios, and we're not doing worst case scenario tariffs. I think Trump genuinely wants to see a lot of activity come back to the US. I think it's happening. I think he's willing to bear the political cost of people screaming that it's not going to work. But then I think he loves this idea of like, look how many dollars we've collected in tariffs. It's a huge talking point for him. He kind of goes off on tangents into it everywhere he gives a speech. He loves this idea of like, we're collecting all this money. It's obviously coming from producers, consumers. Fine, we all understand that. But like, I think it's less of a shock at this point and more of like hey, this is just the way it is. It's like gravity. We all just have to like work around it.
What do you think about that? Free market capitalist, not just Pfizer, but like the stake in Intel, the stake in Lithium Americas, just the US getting involved, Uncle Sam getting involved in corporate America.
Well, Trump is not a capitalist. Trump is a mercantilist. It's a nuance that I think people need to understand. Let me read you the official definition of mercantilism.
Please, so I don't have to.
Okay. Mercantilism is a historical state-driven economic system focused on national wealth through exports and gold accumulation via trade monopolies and colonialism. Capitalism is a modern system based on private ownership, free markets, and profit maximization through competition, investment, innovation with minimal government intervention. This is maximal government intervention.
Mm-hmm.
This is a belief in profitability, but only so long as that profitability does not come at a cost to the government's aims. In this case, make America great again. So mercantilism is the belief that corporations should serve the state and that corporations should be able to do what they want to do so long as they share the same goals as the federal government in this case. So in other words, yeah, we want Intel to make money so long as Intel is building its chips here and that's in service to what we think are our national security priorities. We need to have chip production here in the US. By the way, I'm not saying that's wrong or we shouldn't do that. I understand the strategic import of having pharmaceutical companies be able to manufacture drugs here and not in Asia, just in case we're at war with an Asian superpower. I totally am on board with that, but it's not capitalism, it's mercantilism. And we've seen examples of that in the 1600s and the 1700s. We had companies like the Dutch East India Company. Yes, it was for profit, but also it was about colonizing and planting the country's flag in territories. So it was like this kind of dual purpose aim. Yeah, these are capitalists and business people running these concerns. The Dutch East India Company, they had the South Seas bubble that was driven by a kind of mercantilist. So I think it's okay I think it sort of makes sense if we think, the next big conflict is going to be between the U.S. and China, and hopefully it's not. But like, I sort of understand that mercantilist instinct. Nobody should look at this and say it's capitalism.
Okay, we've talked a lot at a high level, but I know a lot of people want to know, what are you into these days? Let's get into your pro picks. Pro Picks is brought to you by ATB Financial. With $62 billion in assets, ATB Financial is powering possibilities for more than 820,000 financial services clients in Alberta and beyond. ATB's capital markets arm is a full-service investment dealer that offers investment and corporate banking, sales and trading, institutional research, and risk management. Visit atb.com/inthemoney for more information. Okay, Josh, the first one is Uber, and we actually did get a question on that from a guest who bought it on your recommendation when it was around $60. Do you still love the stock here?
I do, and I want to be really clear that I don't make recommendations. So when I am asked in the media about stocks, it's always about what I am doing for myself. I don't care what other people do. I can't, how could I give a recommendation to 100 million potential people? I don't know anything about them. So, but I am personally invested in Uber. It's my biggest position.
Your biggest?
And I'm in the stock since I have prints in the 20s, but I think my average cost is in the 40s, and I have not sold any. And I just think that Uber is the cheapest of the large cap tech platforms. It's probably going to have 25% growth in 2026. And it's selling at 16 or 17 times forward earnings. And that is an absurdity relative to the multiples that we see in other large cap and mega cap tech. I understand the reason for the discount is that people are worried about autonomous taxis being a competitive threat. Amber, I just see it the other way around. Uber's biggest cost is the human driver take rate. And as autonomous driving becomes a global standard, Uber's going to make so much more money in that scenario that it will be okay that there's also Tesla, Cybercab. It's okay that there's also Waymo. You'd rather have more competition and more profit margin, I think, than having 90% of the market, but having what I would consider to be inefficient methods of delivering things and driving people around.
So you like the play on driverless.
Yeah.
That's what takes it the next leg higher.
Yeah, I think the Uber Eats business is going to be drones and robots. Look, right now you order a burrito, it's a guy driving a 4,000-pound car.
Yeah.
Delivering you a burrito. It's an absurdity. And a lot of that cost will come out of Uber's operations as things become autonomous. So I don't think autonomy is the bear case for Uber. I think the market has it wrong. I think that's the bull case.
Okay, your second idea is Amazon. Everyone knows Amazon. It is flat in 2025, a total nothing burger so far this year. Still hanging around the highs, but I mean, is that the opportunity that it's kind of been left in the dust a little bit?
Well, in fairness, I've been wrong on Amazon because I went into this year thinking that it could be one of the better performers, and it's not. So I'm wrong on the name, but I've added to it, and I think that people are underestimating the Anthropic / Claude opportunity that Amazon uniquely is positioned for. Claude has more enterprise customers around the world than OpenAI. If you can believe the recent press releases, Anthropic is, I think, positioned to be one of the big winners in enterprise and by extension, the Amazon cloud, AWS. So I think the best is yet to come there, and I'm not giving up on it.
So I feel like that's been the bearish case around it is like, yes, Amazon Web Services, it's got cloud, but maybe it doesn't have enough of like the nice AI cloud that everybody wants. You think that's going to show up?
Yeah, I don't believe that. I think Amazon is doing things like making their own chips for inference and testing, and I think they're going to be a much more significant player in AI than the market is currently giving them credit for. And that's okay. We've seen that we've seen that a million times before. So
your third pick, maybe less of a household name, is Rocket Companies. People might know it through its retail mortgage lender in the US, Rocket Mortgage. Is this just a nice way to play rate cuts? Or is there something more there?
Yeah, I think this is a company that spent the last 3 years during the housing bear market doubling and tripling down on being the biggest and best vertically integrated provider of the entire cycle, the entire consumer experience of buying a home. They acquired Redfin, which is where a lot of people's searches for homes begin. There are buttons all over Redfin to do a Rocket mortgage. That's like the front of the funnel. Then there's Rocket Mortgage, which has been around, they've been in the business for 40 years. And then they bought a company called Mr. Cooper, which is the largest mortgage servicing provider in the country. So not only now will they be part of the picture when you're first searching for a home, then picking a realtor or picking a house, then getting your mortgage, then you're being serviced by the Mr. Cooper business, which will rebrand as Rocket. And then there are so many other financing activities that come along after, like HELOCs and things of that nature. So I think they have a shot to be like the Uber of home buying and housing finance. Like I think, or the Amazon, like they really have doubled and tripled down. Rates getting lower is great. I think it leads to more existing home sales, and it leads to a lot of refi opportunities. Rocket's refi engine is a supernova. Like no one will make more money from refi activity than they will. So that's why I'm bullish there.
Okay, your final pick here is TOST, point of sale software for restaurants. There's a Canadian, maybe comparable, Lightspeed, which hasn't done as well and is obviously much slower, and growth is slowing there. Is growth slowing at TOST? Why do you like it?
No, growth's not slowing. TOST has pulled back because they changed the pricing for a particular segment, the sub $1 million restaurant, like the very mom and pop. They changed their pricing there, and it spooked the market. The market looked at that and said, "Uh-oh, maybe there's demand weakness or whatever." It's not a really big part of what TOST does, and I thought the pullback was silly. But what are you going to do? I'm an investor here, not a trader. I started buying it in the teens. I should have bought a lot more back then. I've bought it as high as 40, I think. So I've raised my average cost, but I've increased my position. TOST has a really unique opportunity to take the entire ball of wax here. I think this could be a business. Look, they're already now the dominant player. There's competitors. There's Square. There's Clover, which is owned by, I think, Fiserv. They don't have the whole thing to themselves, but I think they could. I think everywhere you go, you're seeing their point of sale. What you're not seeing is the software that they sell to restaurant owners and large corporate chains to power all these other aspects of running a hospitality business. Everything from reordering food for the chef to payroll stuff for the restaurant manager. Once they get the point of sale system in, then they can horizontally sell tons of other products and software services to these restaurants. And I think the product is really sticky. I think once they get in, there's not a lot of churn. So I'm super bullish on TOST as a platform. It's a really unique stock, and I intend to stay long.
Josh, what an absolute pleasure. Thank you so much for taking the time to chat with us.
Amber, this has been so much fun for me. Shout out to all my friends in Canada. And I hope people that have never heard of me before that listen to this like me, and check out my best out here, guys.
And check out his podcast, The Compound and Friends, which is one of my favorites as well. It's on the roster. One of the many things that you do in addition to being the CEO of Ritholtz. Well, thank you so much, Josh. We'll see you next time.
Thanks, Amber. Appreciate it. Thanks, everybody.
Okay, make sure you tune in to our next episode. We've got Mike Rose of Tourmaline. Why does everybody love Mike Rose? We're going to find out in our next episode.